Good morning. Thanks once again for joining myself, Philip Olagunju, Head of Corporate Finance at PEM in Cambridge, and Jack Meaning, who is UK Chief Economist at Barclays, for this webinar entitled Preparing for Your Business Sale. The agenda we have for you this morning is that Jack will be speaking shortly on the macroeconomic effects on business exit and timing. That will be for about half an hour or so, and then at 10:30 I will come back on and talk through M&A trends, factors to consider in preparation for sale, and then there will be a short period for Q&A at about 11 o'clock. So there should be a Q&A function on your screen. So by all means, please do drop in any questions that you have as Jack speaks or as I speak. And then using the wonders of technology, we shall try to facilitate a Q&A session at the end of our talks. That's all from me. I'll now hand over to Jack, trusting that we've worked out how to pass the ball to each other.
Thanks, Philip, and yeah, thanks for having me along. Let's hope I can work the technology. If not, it's almost certainly me rather than anything to do with the technology. If I get a nod that people can see those slides, fantastic. All right. I mean, look, I'm, as Philip said, the UK Chief Economist at Barclays. My job is to come up with Barclays' view on what is going on in the UK in the macro economy. So where do we think economic activity, unemployment, inflation and interest rates are going? And it's a very exciting time to be involved in all of that because we're not short of events to be thinking about. So what I'm going to try to do today is to give you that macroeconomic backdrop that will be informing the more kind of detailed discussions that you will have about your particular circumstances on exit and understanding the kind of intricacies of that. But it's really important to have, I think, that economic macro backdrop because having an understanding of where we are and where we are most likely to be going and the risks around that is a crucial part of deciding not just when and if this is the right time to think about exit, but also what the right process to go through might be across the various options, and also give you a kind of an idea of where appropriate valuations and kind of things can be as well. Key to that will be where we are in the economic cycle, but also what is the outlook for things like inflation, unemployment, as I said, kind of interest rates. So I will be trying to cover all of those things. But also there is a large element of this which will be politics and policy. And I think that's front of everybody's minds at the moment, both home and abroad. So I'll try and come towards that quickly towards the end. Let's start with the economic cycle. And if you'd asked me about 3 months ago where I thought the UK was in its economic cycle running into this year, I would have absolutely said, well, we're about due an upswing and the scene is set for that to start taking place. Here you can see real GDP growth, so the kind of activity in the economy on a quarter-on-quarter basis. And you can see that really since the second half of 2022, bar some slightly dubious spikes in specific quarters, those bars are pretty low by historic standards. I've cut off some of the COVID swings because they just make the chart look unintelligible. But we were relatively muted in terms of economic activity. And that had been because we had had a sequence of shocks which essentially kept the economy depressed. We obviously avoided outright recession in any meaningful way, but we weren't growing anywhere near as quickly as we could have done. Part of that was Russia-Ukraine and external events. Part of it was domestic events around government policy, but there was also just an element of confidence within the economy as well. Now, we had started to see that pick up, and actually the underlying fundamentals of the UK economy were relatively positive. So you can see it in terms of household balance sheets. So if you look at metrics over the last few years of real incomes for households, even though we've had a kind of an increase in inflation or elevated inflation, households' real incomes have been relatively stable. The unemployment rate by historical standards has been relatively low. And here you can see a metric which are corporate margins broken down as kind of overall kind of non-financial corporates in that dark blue line, which are by no means high, but if we go back to kind of the early noughties, we're at levels that are relatively consistent to where we've been kind of in that kind of, late 2000s through to the 2010s. So by no means low and depressed in terms of corporate margins. And actually in the service sector, they were even higher than kind of historical norms. Manufacturing less so. Again, the UK's balance of those things is more skewed towards services. And so actually we think that we were in a position where actually, the financial backdrop for firms and for households was relatively robust. That's not to say that there weren't pinch points. Obviously, things like government policy around national insurance contributions, around certain regulations, they all played their part in making it not a completely benign environment for businesses. But the fundamentals were relatively positive, and we saw some of those green shoots of growth come in around the corner. The difficulty was that obviously at the end of February, another shock hit the system. And this is one of the things that will be a theme as we kind of run through this is, being alive to these macroeconomic developments requires you to be able to change your view and be adaptive to shocks. And so what we have seen is obviously the conflict in the Middle East breakout. And here I'm just showing an indexed version of oil prices to show you that actually the light blue line here is what happened to oil prices as we move through the Russia-Ukraine invasion in 2022. And you can see, although it's slightly kind of more abrupt, where we are now on the oil price, which is around about, we've moved from about $65 a barrel to around about $110 a barrel. That is broadly comparable to where we were at this point in the start of the Russia-Ukraine crisis. And we can have a debate about whether the conflict in the Middle East will kind of be as protracted as that Russia-Ukraine crisis. But on the oil side, at least, there are some similarities there in terms of the pass-through to the UK economy. But what is more important, more relevant, again, this is understanding the economic backdrop and how it pertains to the markets you are in. But what is more relevant for the UK, this is a big deal for some European economies, for obviously kind of manufacturing economies in the US. The UK is really much more sensitive to what's going on with the gas price. And here you can see a material difference from what we saw in 2022. So here again, the light blue line shows we had these spikes in sterling gas prices, and they were incredibly high, came back down, but then again rose incredibly high. The dark blue line is what we've seen so far in terms of sterling gas prices for Russia, Ukraine. We're not even talking really of a third of some of those peaks. And so, it's a different order of magnitude in terms of shock. Nonetheless, it is a shock to the economy, and it is what we as economists call a terms of trade shock, which means that the things we sell to the rest of the world are relatively now cheaper. The things we buy from the rest of the world are more expensive, and that essentially makes us poorer as a country and will drag on real incomes and therefore will drag on growth. And you can see here, this is real incomes for households, so they're kind of their spending power. And you can see if you look through 2021 and 2022, there were dark blue bars, which is the terms of trade shock that we had previously. They were dragging down growth in that metric. We would expect something similar to happen now. And actually, when we run through our best modeling of this, based on our kind of understanding of where things are in the Middle East at the moment, where financial markets are, we probably think this is a hit to UK GDP of around 0.5%, which in an economy that grows somewhere around 1 to 1.5% a year is not a small amount. But if it is just that and it's a temporary push through, then actually, it's not the same kind of hit we're talking about from things like Brexit, from COVID, from the financial crisis. This is not the same order of magnitude in terms of those hits unless it intensifies. We can see this already starting to come through in some of the more high frequency data. So there are lots of metrics that we can look at that tell us consumer confidence, that tell us investment intentions. They are all looking like they are starting to soften. But at Barclays, we are incredibly privileged. We get access to data on payments made through Barclays cards, spending and card network. We essentially see more than 40% of spending across UK point of sale and cards almost in real time. We obviously, it's all aggregated and anonymized, but it gives us this really granular, detailed look at the economy. And what you can see here in this kind of table I put up is essentially what we call a heat map of the various sectors. So green is kind of, the more green you have here, the more strong the performance in that sector is over that period. And what you can see here is actually, as we move from the left to the right through time, from the end of February to kind of broadly middle of April, which is our last published snapshot of this, all sectors, with the exception of digital content and fuel, have deteriorated. So we're already seeing this slowdown in consumer activity, and it's broad across sectors. And we think that will mean that this year that will continue, and we will continue to see essentially soft demand coming through. So you're probably only going to see quarterly growth rates in the UK economy of 0.1, 0.2. As an aside, though, a little statistical quirk to keep your eye out for if you're following UK developments this week is there will likely be headlines tomorrow about a pretty strong UK performance in the first quarter of this year. We think you'll probably see growth of about 0.6%. In honesty, our kind of analysis suggests that that is slightly illusory, that there will be noise in the data, statistical quirks that will mean that actually underlying growth is much more muted, more like 0.2%. So don't be fooled if you do see those headlines. It doesn't immediately negate the story I'm telling here. It's more a function of kind of some hidden away spreadsheets and calculations being done in the Office for National Statistics. Now, these factors that I've kind of run through are going to be absolutely key in terms of thinking about timing for exit, because what we know is that the environment is invariably more favorable when growth is strong in the economy more widely, when confidence is high, and when we know that firms have confidence in investment intentions, both in financial sectors and beyond. And that, is a story that you have to watch through here, because if the Middle East shock is relatively short-lived and temporary, if we get some resolution in the next few weeks, maybe the next month or so, then actually this short-term softness in the economy is something that actually will reverse relatively quickly as we move through into the start of next year. Whereas if the Middle East conflict continues, intensifies, becomes worse, then actually this could be the precursor to something more persistent in terms of softness in the economy. And then there are open questions about, well, is now the time to get ahead of that? Is it better to see a temporary shock through and come out the other side? And all of that will tie into exactly what you think is going to happen to things like rates and other parts of the context that I will come to, which is why, again, you should be taking this broad macroeconomic view and playing it into something more nuanced for your own situations and views on the world. So yeah, I should say our base case view here is that this is a kind of economic recovery that is delayed, not denied at the moment in terms of our view on the Middle East, but uncertainty is incredibly high. What does all of this mean for the next part of the kind of the macroeconomic nexus, which is inflation? Well, I would have been telling you again a story if we'd talked a couple of months ago of essentially inflation Goldilocks. The UK has had a problem for the last 4 and a bit years now, with inflation sitting higher than target. There's an ongoing debate amongst economists around whether that's something just structural, it's a mistake by the Bank of England or a change in the makeup of the economy, or whether it's just misfortune and a series of negative shocks that have hit one after the other. My view, based on our analysis, is that it's predominantly the latter, that we have had a series of shocks, not all of them misfortune, some of them bad policy, that have each temporarily boosted the inflation rate, but they've just overlapped. And that has kept inflation above 2% for most of the last 5 years. But we were looking at a world in which by April this year, so the next set of numbers we would have got, we would see inflation back down to 2%, which is the Bank of England's target. And that would have basically boosted real incomes. It would have alleviated some of the cost of living pressures. It would have led to more confidence coming through. All of that would have been good in terms of the economic backdrop. But the shock itself is quite clearly inflationary. Anyone that's looked at trying to book flights and kind of seen the implications of jet fuel increases will know that things in the economy are becoming more expensive, and we think they are set to become even more so over the coming months. So if you look here, you can see our forecasts. You can see that story in the dark blue line I was telling you before. That was our inflation forecast before we had the shock in the Middle East. We now think that rather than being around 2%, you're going to see inflation fluctuate somewhere between 3.5% and 3% this year. So a material amount larger in terms of the inflation rate. And that will have implications because it will erode people's spending power, but it's also symptomatic of cost pressures on firms. And importantly, the reason when you're thinking about exit, that I would say that inflation and the outlook for inflation matters more than anything is because this is the big indicator of exactly what is going to happen with interest rates. In that world before of the dark blue line here with inflation coming back down to target, we thought that we would see a world in which the Bank of England cut interest rates one, maybe two more times this year, following a sequence of 6 25 basis point cuts that we've seen over the last 18 months, which would ease conditions, it would make credit more available, and again, would be a more beneficial environment in terms of thinking about exit. What we have seen and what we are now expecting, if I move on one, is something more like this. So rather than expecting cuts, rather than expecting the dark blue line to end up falling further, more towards 3.5%, 3.25%, we now think it will be on hold. We think we'll stay at 3.75% for the rest of this year and actually out into next year, most likely as well. But the market, as you can see from the green line here, is taking a slightly more pessimistic view. It actually thinks there'll be 2, maybe 3 more rate increases this year. And that's important because that has materially tightened financial conditions out in the economy more broadly. So some parts of the economy are directly tied to what happens at the Bank of England and bank rate, but actually a lot more of it is tied to kind of market rates that have wider spreads. I'm sure I'm kind of not telling anyone anything they don't know on that. But that tightening has been even more notable. So across all of the different metrics you can think about for financial conditions and the cost of credit, we bring them all together in this financial conditions index that we point. This is the line here. And what you should tell from this is as you move down, kind of lower on this chart, financial conditions get tighter. So credit is less available, it becomes more costly. And you can see if you look in 2023, 2024, financial conditions were basically the tightest they'd been since the financial crisis. And then we spent 18 months or so moving all the way back up to relatively easy financial conditions, or at least ones that weren't weighing on the economy anymore. And that was giving the economy the boost that it needed. Unfortunately, what we have seen just in the last few weeks is that line take a bit of a nosedive back down. And actually, if we were to update this for even more recent data, it would show that we were broadly back at, kind of where we were in mid-2024. That's a story that we hear across a whole range of metrics on credit conditions, because if you look at, say, a 2-year fixed rate mortgage at the moment, they are at the same rate that they were in essentially June 2024, before the Bank of England started cutting interest rates, which means if you're just following what the Bank of England is doing, you would think, well, actually, this is a good time for credit. Credit conditions are pretty easy at the moment. Following these other metrics and having the broader picture, that person dropping off of their 2-year fixed rate mortgage essentially feels no benefit from the easing cycle that has happened over the last 18 months. They're fixing at the same rate that they would have fixed at if they'd when they originally took their mortgage out in 2024. And that is true across a whole range of borrowing and credit metrics. So understanding those differences between, basically what's happening with the Bank of England, which is a large determinant of it, but also what's happening to spreads within credit markets and what that means for actual credit conditions felt on the ground is fundamental. More generally, obviously, a credit cycle, an interest rate cycle will affect your views on exit through the cost of credit directly, but also because it will have consequences for the outlook for growth. And it's also a baseline for broad returns. So again, the higher the interest rate, the tighter the conditions, the more you will need to be an attractive proposition in terms of delivering returns that are higher than that alternative, which is to lend money out into the economy or kind of invest in something that's on deposit. So that, I think, is kind of a key understanding here in terms of where you need to be looking for metrics for the attractiveness of otherwise of credit conditions. A big underlying theme across a lot of what I've been saying, I've used this word a lot, I think policymakers and commentators use it even more than I have, is uncertainty. And understanding uncertainty and its consequences is absolutely crucial, because we never get rid of it entirely, but particularly at the moment, we are looking at a macroeconomic backdrop where you will have to make decisions around exit and around anything strategic under a baseline of significant uncertainty. And to quantify that, what I've got here in this chart are a range of metrics of measured uncertainty. The green line is trade uncertainty, the light blue line economic uncertainty, the dark blue line is migration uncertainty. And you can see they are all at incredibly elevated levels at the moment. They've come off maybe in the last kind of few weeks. I would think that actually if we start to get numbers that encompass the last few days in the UK, at least the economic uncertainty index will start to pick up. But we are now operating in a world of significant uncertainty. If I were to take this chart back 100 or so years, for which only some of these series are available, you would see that trade uncertainty, for instance, this is the highest level it's been since the kind of the interwar period and the kind of the 1920s and early 1930s. So we are in a world where tariffs and the international environment is incredibly important. Trade uncertainty at the kind of the spikes we had through the last 12 months is incredibly high. Anyone operating in an international environment needs to have that in their mind. But the most brutal part of the uncertainty impact on the outlook and any decisions is that it dampens demand and it makes people hesitant to make big, irreversible decisions. So again, if you're thinking about something like that, it changes maybe your preferences under uncertainty as to how you would go about making that decision. It makes the bar for really having done your homework and being able to kind of have some view on different scenarios and how things come out, or how things could play out, and making sure your decision is robust to all of those as incredibly important. But again, it also saps demand, which when you're thinking about valuations, if you're operating in that world, you need to bear that in mind. We obviously have our own homegrown kind of brand of uncertainty in UK politics at the moment over the last few days. I don't want to get into the ins and outs of exactly where that stands, but it does have material consequences, whichever way it plays out. So what I can show you here is just a quick chart on essentially a measure of the government's fiscal position. So what you are seeing here is that the change from one bar to the next bar, so from 1 year to the next, is the extent of fiscal tightening that is expected by the government, the burden the government's fiscal position in terms of tax and spend is putting on the economy. And what you can see is the swing from this year in 2026 to next year is pretty sizable. It's kind of 0.7% of GDP, which is a drag on the UK economy, coming from the fact that the Chancellor is having to essentially tighten her belt and the belt of the country's fiscal plans in order to be able to deliver credibility against her fiscal rules that she has set herself. Now, that was fine in a world that we were looking at 3 months ago, because the private sector, corporates, businesses, households, we expected them to pick up the slack. We've had growth in the UK that has been partially dominated by the public sector, but we thought we were broadly seeing the signs that the private sector was going to come through and step up. Now, with this new shock, it's less likely that's going to happen, and the increase in government bond yields we've seen in response to global developments, but also domestic political uncertainty, means that this picture is even worse for the Chancellor. So she had roughly, in her fiscal rules, about £24 billion of headroom. Just the increase in government bond yields alone in the last few weeks has probably eroded somewhere like £7 billion out of that. So, a decent chunk. And if she wants to be able to claw that back, her options are really to be able to go out and think in the autumn about more tax and spend. And so having a sense of where those fiscal pressures are, because they will invariably affect tax and spend decisions that will then affect businesses. If the Chancellor needs to come and raise another 7 or 10 billion, what type of levers is she going to look at to do it? That is vitally important. We currently have a lot of uncertainty, so it's hard to plan. But as I say, the fiscal arithmetic this far out from the next big fiscal event is relatively difficult. I'm just going to finish very quickly with something a little bit more upbeat, maybe, because one, you can't give a presentation in the current day and age without mentioning AI, but also because I think there are genuine opportunities here to kind of think about. So these stats that I've got on the screen come from a survey that we at Barclays take of corporates around the UK, and they essentially show that AI is being adopted in broad sectors in a broad number of ways, and that people are planning to do more of it. And actually, some of the things that aren't here, more than a third of people that are using AI in their firms are seeing it reduce their cost base, which is making them more efficient, which is making them essentially more attractive. And my reason for bringing this up is because I think there are definite opportunities when you're thinking about the macro backdrop and macro trends in terms of how you make yourself suitable for exit, around thinking about, well, okay, am I using all of the opportunities that are out there to make myself as attractive as possible? So, I mean, a case in point, this doesn't have to be an AI related point. This could be sectors where you think you're more likely to do well. It could be elements where you think the UK has comparative advantage or the public sector is investing. But just on AI alone, let me just show you this chart. So this is the performance in European, not just UK, AI and AI adjacent companies versus those that are not AI adjacent. And you can see in terms of valuations here, they've just diverged pretty consistently since the first half of 2025. And that's not a small difference in valuation. You're talking about, based on the index, you've kind of got more than 100% of the initial starting level as a difference between those two. So again, thinking about how you can utilize those things out there in the macro trends to give you a better proposition, I think is crucial. Philip, let me stop there. I'll let you give the more insightful and useful bits, and then see if there's questions.
Excellent. Thank you, Jack. That was really, really insightful. And so as we hand the baton over, I will be talking about M&A, and there are some really neat themes that overlap between Jack's talk and my talk. So what am I going to be discussing today? M&A trends, what have we been seeing anecdotally, but also by way of research that my team and I have carried out. What's our perspective? So what are we seeing against the backdrop of what the research is telling us? And what are some of the things that are helpful to think about when getting ready to transact? And so right from the outset, in terms of UK M&A, whilst things have appeared to have slowed down from a local and regional basis, well, anecdotally at least, research suggests that deals have been happening across the UK and within specific sectors. I just mentioned my team. My team and I have used structured evidence-based research sources such as Merger Market, RSM, McKinsey, Boston Consulting Group, IMMI, Baird, and other sources to provide an update on what has happened in the UK over the last 2 years from an M&A perspective. And so all stats in the charts are on an annual basis, not on a quarterly basis. So if you think of them as a rolling 12-month aggregate, it starts to build a picture as to what's been going on. So for large deals, and it's the chart that's on the page now. And what do we mean by large deals? Large deals are deals valued at £1 billion and more. We can see that deal values. And so when I'm talking about deal values, I'm talking about how much deals are going for, and that's the blue line on the chart. And deal volumes, so you're going to be hearing me talk about deal values and deal volumes. So deal values, how much a deal is going for, deal volumes, the number of deals that are being completed, and that's the orange line on the chart. You can see that in the context of large deals, there's been quite a bit of oscillation over the last 2 years. The market saw a low point, Q1 2023, there's a low point of only 2 deals. But again, it's important to be clear here, only 2 deals, but at a value of 2.3 billion. And then there was a high of 15 deals at a aggregate value of 27 billion, Q3 2025. And in total, when we look at 2025 as a whole, there were 12 large deals, an aggregate value of 23 billion, indicating that whilst people might say that M&A has slowed down, the evidence suggests that there's been quite an active market at the top end of the range. And then when we talk about a compound annual growth rate, so what's been happening on an annualized basis, we can see there's been a growth rate of 34% in deal value and 32% in deal volume between 23 and 25. So growth across the board for large deals. And so that's large deals, £1 billion plus. What about upper mid-market deals? So there's segmentation between small deals, large deals, middle-sized deals in the M&A space. And what we can see for the upper mid-market, which is deals between £100 million and £1 billion, deal values and deal volumes have also oscillated over the period, albeit at a much lower rate of volatility. We can see that there were 34 deals at £11 billion aggregate Q2 2023 to a high of 63 deals and 20 billion aggregate value Q4 2023. And by Q4 2025, there were 46 upper mid-market deals at an aggregate deal value of 12 billion. And so overall, in terms of compound annual growth rate, there was a 2% increase in deal value and 6% increase in deal volume between 23 and 25. So there's been growth in this M&A market segment, albeit at a far lower rate than the larger deals that I spoke about previously. And so when it comes to lower mid-market deals, so these are deals below 100 million in value, deals below 100 million in value, deal values and deal volumes have been relatively flat over the last 2 years. And again, it's just worth noting the maths here. It takes a smaller number of large deals to be worth the same number of small deals. So for example, it will take 100 deals at £20 million each to be the same aggregate value as 2 deals at £1 billion each, right? So it's important to just bear that in mind, because we'll see that in the stats. So there was a spike in activity in Q4 2024 where there were nearly 1,000 deals that were done, but only at an aggregate value of 5 billion. And so if you compare that to the large deal space, where there were 10 large deals at an aggregate value of 20 billion, you can start to see the differential in some of these statistics. And there were only 34 lower mid-market deals at 11 billion Q2 2023 to a high point of 63 deals at 20 billion Q4 2023. And by Q4 2025, you can see on the chart there was 71 lower mid-market deals at an aggregate value of 3 billion. So, and overall, there was actually a contraction. There was a contraction in deal value of 3% on a compound annual basis, but a positive 13% compound annual growth rate in deal volume between 2023 and 2025. So what does that all mean? I've just been speaking quite a lot about numbers over the last 7 or so minutes. It supports the view that M&A activity has remained relatively stable and was active over the last 2 years. And whilst deal volume was lower at the larger end of the market, the values were much higher, given that the deals were priced at £1 billion and above, right? And a quick segue into PEM. So at PEM here in the corporate finance division, we are intentionally lower mid-market advisors. Personally, I believe that that's where all the action is. And in my mind, it's the part of the market that is more representative of the SME lifeblood in the UK economy. And Jack spoke very eloquently and knowledgeably about the different macroeconomic factors that feed into a decision around exit. So I think the lower mid-market is the place to concentrate on. So with this in mind, we carried out research that focuses more on the lower mid-market space. And we've started with the geographic distribution of buyers in the UK lower mid-market. So the companies that are doing the acquiring, that are doing the buying in this space, where are they based? And over the period, the majority of buyers in the lower mid-market space have been UK based. So on average, about 65%, followed by North American acquirers that kind of make up 12%-ish of the demographic. However, buyers from Western Europe have recently overtaken US buyers, and with the rest of the world kind of bringing up the rear at 5%. And in terms of compound annual growth rates across the buyers split by geography over the period 2023 to 2025, we can see that North American representation fell by 9.4%. Europe has remained relatively flat, about 0.1% CAGR, compound annual growth rate. The rest of the world fell by 1.1%, and UK buyers increased. It grew by 2.1% over the period. This gives a different sort of flavour to the saying buying British, right? Buying British. And so continuing with this theme of lower mid-market focus, right? We've looked at certain specific sectors and how they've performed over the period, namely pharma, medical and biotech as one collection. Then we flipped into TMT, that's technology, media and telecoms as another sector, and industrials and manufacturing as another sector. And so on the screen now, we've got a look at pharmaceuticals, medical and biotech, and we can see there's a divergence between deal values and deal volumes across the trend lines, right? Typically, when values are up, volumes seem to be down, and vice versa. And the inference here is that larger deals tend to drive the activity in the worlds of pharma, medical and biotechnology. Lower deal volumes still produce high aggregate deal values. And in overall terms, between 2023 and 2025, deal values fell at a compound annual growth rate of 3%, whereas deal volumes increased at a compound annual growth rate of 3%. And so, there might not be much activity, and then you hear of a mega deal that's been done in this sector. That's contrasted with what we are seeing in the TMT space, technology, media, and telecoms, there's a clear alignment between deal value and deal volumes across the trend lines. And typically when values are up, volumes are also up, peaking at 1.3 billion aggregate value across 203 deals in Q4 2024. However, there has been a contraction. There has been a contraction in activity between 2023 and 2025. Deal volumes fell at a compound annual growth rate of 10%, whereas deal volumes also fell by 1%. And what's the picture when it comes to industrials and manufacturing? Well, it's clear to see that industrials and manufacturing has seen a lot of positive M&A activity in the UK lower mid market. This is underlined by the deal values having increased by a compound annual growth rate of 14%, and deal volumes at a compound annual growth rate of 26%. Across the 2-year period. So there's been clear growth across the board when it comes to industrials and manufacturing. And from our perspective, that corroborates and verifies that view, but I'll come to talk about that in a moment. So just shifting gears slightly, and what are we hearing? What are we seeing? And frankly, the picture in the UK has been relatively positive over the last 2 years based on the charts and the data that I've shared. Global M&A has been slowing. It has been slowing. And primarily because of some of the factors that Jack touched upon in his segment earlier on, namely high economic uncertainty, interest rates. We've seen the movements in interest rates that has an absolutely cascading impact on M&A activity, tougher regulatory scrutiny, geopolitical tensions, and we've seen a widening gap in valuation between buyers and sellers. And I'll just drill into each of those for a couple of minutes. So macroeconomic uncertainty and weak market confidence. We've seen sluggish economic conditions, as Jack has alluded to earlier on, and trade uncertainty. And both these factors are causing both acquirers and sellers to delay processes. And we've seen that ourselves. We've had a couple of projects slow down, delay, get put in the fridge due to factors beyond everyone's control, right? Businesses want clearer market signals and lower rates before they fully commit to carrying out transactions. And then political uncertainty. We've seen a lot and we've heard a lot around tariffs, US tariffs, and these tariff changes, they cause a shift in economic policies, and it creates risk aversion and delayed transactions globally. This is an interesting stat that the US Economic Policy Uncertainty Index reached one of its highest levels in 40 years back in 2025, contributing to reduced deal appetite. And this explains one of the previous charts I showed, where there was an overtaking of US buyers by Western European buyers. US buyers, due to their domestic policy and foreign policy of the government, has kind of slowed down their M&A activity, and Western Europe have stole a bit of a march there, which is clear to see. High interest rates and cost of capital, persistent high interest rates from a global perspective, have made acquisition financing more expensive. It dampens deal making and it widens the valuation gaps. And although rates have been beginning to ease, we've seen renewed uncertainty, and it reverses optimism for a strong rebound, as Jack alluded to. And I promise you, we didn't swap notes prior to this. We kind of took a dive into the dark and see where we would come up with, and it's very reassuring that his narrative and my narrative aligns. So excellent. Heightened regulatory scrutiny and longer approval timelines are absolutely causing a slowdown in global M&A activity, right? Regulatory reviews have become more complex, they've become time consuming. Approval timelines have increased by circa 35% for major deals, and lengthy reviews rising 50% over the time frame of 2017 and 2022, and that's just increased up until now, 2026. More countries now operate independently within their own regulatory frameworks and their own regulatory assessments. So that adds unpredictability and that adds delays to M&A processes, right? And about 30% of the largest global acquisitions in recent years experienced delays beyond the control of deal makers. Again, we've experienced that ourselves at PEM, where a couple of deals that we were working on were due to complete at a particular time frame and everybody was aligned to get there, and then something happened outside of everyone's control which just delayed the process and kicks the can down the road, right? Geopolitical tensions and trade policy shifts. Again, Jack alluded to this earlier on. Tariff hikes, the Strait of Hormuz, is it open, is it closed? Trade policy, who's going to be leading the government in the UK? All of these things have increased uncertainty, certainly in terms of cross-border deal making. Businesses are waiting for greater clarity on global trade frameworks before doubling down and pursuing acquisitions. Valuation gaps between buyer and sellers. Rising rates have created significant mismatch between buyer and seller expectations. No, sellers have sky high expectations as far as buyers are concerned, and buyers are unwilling to pay what a business is worth from a seller perspective, and this gap has just widened in 2026, causing deal delays. I've mentioned it before. We had a deal fall over very, very recently where the gap between what the buyer was willing to pay and what the seller thought the business was worth was just a bridge too far, right? And so additionally, sellers are struggling to meet performance projections. No, we're in a weaker economy. We saw that earlier on through Jack's slides. And so if your business is trading weaker than you'd like it to, certainly not matching forecasts and budget, the idea might be to press pause on exiting and wait for trading to bounce back before committing to a process, right? Operational and integration complexity, more cross-border deals and complex integration requirements have increased execution risk, contributing to delays and cautious behavior. And there's some sector-specific divergence. While overall activity is subdued, sectors undergoing energy transition, digitalization, we've heard about AI and the impact of AI and AI-driven transformation, but we're still seeing strategic deal making in those spaces, and assets that are insulated from macroeconomic uncertainty continue to attract purchasers, and we're seeing that activity maintain. And what are we seeing? What are we seeing from a deal perspective? We're seeing that deals are still happening. Deals are still happening in the lower mid-market. The research supports that, and our anecdotal evidence supports that. So over the last 10 months, we've closed 5 deals, so averaging a deal every 2 months, including the sale of Norfolk-based Greenhouses Direct to an eclectic consortium of acquirers. Mirabel was a trade company. Cantic was a search fund. You had a high street bank that put some capital towards it, and you had a mixture of Western European high net worth investors. They're all coming together to acquire this business. So really, really interesting, and underpins the view that when there's a will, there's a way. We recently sold an independent financial advisor called Absolute Sense. We sold that to Beckett's, and they're backed by mid-market private equity fund Foresight. So what you'll hear is that there's trillions of pounds of dry powder ready to be deployed by private equity funds. And so we were fortunate to come into contact with Beckett's, and they had this dry powder from private equity back in perspective. We recently sold Milton Keynes based manufacturer and engineering business, Project Blue Note. We're under a confidentiality agreement, so we're not able to disclose the name. But the reason why I wanted to put this in the presentation is that it was acquired by a 2.2 billion German manufacturer. So we're seeing this Western European acquirer trend come through in terms of what we are seeing day to day. I've mentioned a consortium of Western European based high net worth investors from France and from Italy. Got a German business here, Strabag, that acquired Crofton Engineering. Strabag is Austrian headquartered. We sold another Milton Keynes based business that is into procurement. We sold them to France headquartered Sodexo, if I can get the words out, Sodexo. So you've got France, you've got Germany, you've got Italy, you've got Austria. Western Europe have overtaken America in terms of the types of profile of acquirers that we're seeing, certainly. And a few years ago, that interest, you could absolutely swap it out for US based acquirers, right? We were speaking to US based acquirers for a lot of our assets. Currently, we're not speaking to any. We've had a North American buyer pull out of one of our processes just yesterday, which kind of underpins what I was talking about earlier on. Valuations are still holding up, but getting to a common ground requires firm negotiations. Buyers want more for less. That is absolutely what we're seeing, and where businesses are insulated somewhat from broader macroeconomic challenges, we're more likely to see a successful deal happening, right? So in terms of preparing for sales, I'm coming into land now. What are some of the things that you need to think about? What are some of the things that the sellers need to have an appreciation for? Well, broadly speaking, sellers need to think about valuation, legal responsibilities, tax implications, deal structure, and preparing the business so that buyers see it as low risk and high value. Low risk and high value. So preparing a business for sale, buyers look for stability, they look for growth potential, they look for clean operations. So sellers should ensure organized records, make sure that you've got a good reporting structure and framework so that you're able to very quickly identify bits of information and you're not scrambling around for paper-based stuff, right? Contracts, paperwork, ensure that everything is up to date. Make sure that your accounts are current. Typically, certainly in my travels, management teams and founders and CEOs like to kick the can down the road when it comes to financial reporting. It's seen as a necessary evil. It's seen as paper shuffling. No, when it comes to selling a business, you need to make sure that you can lay your hands on good management accounts, on good historic records. We've got a transaction on at the minute where we've had to press pause because the financial records were not in a state where we felt comfortable to take it to market. So we've had to press pause and shift our focus to making sure that that QuickBooks is up to date, that the VAT returns are up to date, that the management accounts actually reflect what's going on under the bonnet. Really, really important. A clear picture of your customer base, your profit trends, your market position. These factors make a business even more attractive, and they reduce buyer concerns, right? Really, really important. Valuation and pricing strategy. Your business is not worth what Bob in the pub tells you it's worth because he sold his business for 10 times a year ago. It just doesn't work like that. You need to think about staff quality. You need to think about revenue and profit history, and can those things be robustly presented and defended in a due diligence exercise. And I'll come to talk about due diligence shortly. Liabilities, reputation, growth potential, all of these things feed into what a business is worth. And look, there are common methods for valuation. You can use a price earnings ratio that looks at your net profit, or you can use a profit multiplier which looks at your EBITDA, earnings before interest, tax, depreciation, amortization, which is a proxy for your operational cash. You can look at your cash flow generation in general. You can look at discounted cash flow. There's so many different ways that you can value your business, but ultimately, and here's the key line here, sellers need to balance realism with ambition. Overpricing your business can deter decent buyers, whilst underpricing your business can leave money on the table. So it's really important to speak to someone who does this for a living rather than Terry down a golf club, because Terry hasn't got the answer. If you're going to take anything from this webinar, the bloke down the pub hasn't got the answer, right? Please. What else do you need to consider? I've spoken about that already. What else do you need to consider? Tax implications, right? I am not a tax professional. I'm not about to start talking about tax, but the key thing to think about here is capital gains tax. So selling your business can trigger capital gains tax, and you need to understand whether your business qualifies for business asset disposal relief. I am not going to steal my tax colleagues' thunder. The next rendition of this webinar will be thinking and talking about tax implications for selling your business. So I'm not going to spend too much time on this slide, other than to say, speak to a tax advisor, structure the sale of your business early. Tax planning actually needs to take place 1 to 3 years in advance of a transaction. It's not about scrambling and looking at what you can do once you've got a set of heads on the table. That might be too late. But as I say, a future rendition of this will cover all the beautiful things that tax has to offer. I mentioned it earlier on, due diligence. This is a key area. Advisory support. Now, you'd expect me to talk about advisory support because I'm an advisor and that's what I do for a living. But it's a bit like selling something of value based on your intellectual property versus selling something of value leveraging the experience of an expert, right? You can try and sell it yourself, but you might leave things on the table, you might leave things out. It's much, much better to leverage the experience of someone who does it for a living, because here's the kicker. A buyer will conduct extensive due diligence, which can take months and months and months and be really, really painful. And if you're not experienced in navigating the ups and downs of an EV to equity bridge, the ups and downs of negotiating what is actually surplus cash, what is debt, navigating the ups and downs of what is normalized working capital, what does that even mean? There is a high probability that you will leave value on the table. So partner with people who know what they're doing, prepare high quality financial statements, conduct sell side due diligence early so you can identify issues. Here's the kicker: assemble a team around you. Avengers assemble a team around you, a team of experienced practitioners in corporate finance, in tax, and in corporate law. Your mate at the high street law firm who looks over your commercial contracts might not be the person that you want to entrust with selling your company. Commercial law and corporate law has overlaps, but my advice will always be to partner with a corporate lawyer, because they can manage the process, they can mitigate risk, they can help you to avoid surprises and help you to navigate the bumps, because there will be a few along the way. Preparation helps to maintain deal momentum and strengthens negotiation. So I think there's a summary table which kind of captures it. I'm not sure what the idea will be to share slides eventually, but business readiness will ensure that realistic pricing is maintained and maintains buyer confidence. Valuation ensures that there are smooth negotiations. Get someone to value your business so that you understand how much your business is worth, and not an aspirational 15 times EBITDA, because that's what you heard someone else say. Get someone to value your business on an individual perspective. Legal duties, so make sure that all the legal levers are pulled appropriately, because that prevents breaches and protects employees and the process as well. Tax planning, that will reduce the tax burden and avoid any surprises. Make sure your deal structuring is done appropriately, because that will impact the risk, and things like contracts and then employee transfers and things of that nature. Prepare for due diligence. That will speed up the process and it will help to avoid any deal breakers. Come in for 11 o'clock. That is fantastic. I didn't rehearse that, I promise. The floor is now open for discussions. So I think I'll look in the direction of my colleague James to see if there are any questions that have come up at all, or any questions indeed that you'd like to type in the Q&A section right now. James?
Yeah, no, thanks, Phil. Thanks, Jack. Really insightful. So as we've heard, obviously, Jack's covered what's going on from an economic perspective, and Phil has spoke through the factors when preparing a business for sale. Equally, both very important when owners are thinking about an exit and planning ahead. So yeah, now we'll kind of take the time to run through some questions you may have. I'll do the best not to let down technology side, because you've both done really well. So yeah, we'll open up the floor. If there's any questions, yeah, please pop them in the chat, and we'll read them out, and they can respond in due turn.
Silence is deafening.
I think that's a sign we covered it all, Philip. It's everything's done.
I think so. Well, if there aren't any questions, all that remains for me to say is thank you very much, Jack, for your contributions. Thank you, James, for stepping in and being a bit of a moderator for us. And thank you to all of our attendees for attending. We really do hope that this added value and gave you a little bit of food for thought in terms of preparing for sale, whether it's you directly or whether it's clients or contacts that you're speaking to. And by all means, reach out to myself or Jack via LinkedIn or directly for any questions that you might not want to ask in an open forum, and we'll be happy to respond in due course. But if there aren't any other questions, I'll shift the slide on to PEM, your future, our focus, and wish you all the best.